Switzerland's National Day on August 1st was overshadowed by the stunning news of a 39% reciprocal tariff imposed by the United States. President Donald Trump, on July 31st, signed an executive order applying import duties across 66 economies. Switzerland found itself facing one of the highest rates, surpassed only by Laos, Myanmar, and Syria. In stark contrast, the European Union and the United Kingdom had negotiated significantly lower tariffs at 15% and 10% respectively. This development came as a profound shock. Earlier in April, President Trump had threatened a 31% tariff on Swiss imports. Despite a 3-month temporary reprieve, Swiss officials failed to secure a favorable agreement with the United States. Financial news outlets had previously suggested that a framework agreement was imminent, with anticipated tariff rates of merely 10 to 15%. Swiss President Karin Keller-Sutter expressed her astonishment at the 39% figure. She noted that negotiators had engaged in discussions with the Trump administration just the previous month. But these discussions evidently did not yield an accepted resolution. President Keller-Sutter affirmed her commitment to analyzing the situation and seeking a viable solution. She stated that while the exact outcome remained uncertain, she was certain it would inflict damage upon the Swiss economy. The U.S. trade deficit in goods with Switzerland stood at $38.5 billion in 2024, marking a 56.9% increase from 2023, according to the Office of the United States Trade Representative. President Keller-Sutter posited that President Trump likely selected the 39% tariff rate as a direct rounding of this $38.5 billion trade deficit. She remarked that the U.S. president's focus was clearly and singularly on the issue of trade deficits. The Swiss Federal Council conveyed its deep regret regarding the decision, emphasizing its continued pursuit of a negotiated solution and ongoing engagement with U.S. authorities. Economic analysts quickly weighed in on the potential repercussions. Adrian Predijon, a European economist at Capital Economics, projected that the 39% tariff could reduce Switzerland's gross domestic product by approximately 0.6%, a figure that could escalate further if pharmaceutical products were included. Beat Whitman, chairman of Porta Advisors, characterized the tariff as devastating for the Swiss economy and its businesses. He predicted that this measure would lead to a weakening of the Swiss economy, the Swiss franc, and the stock market, particularly impacting the critically important export sector. The United States accounts for 1/6 of Switzerland's total exports. Key export categories include chemicals and pharmaceuticals, watches and jewelry, chocolate, gemstones, and electronic equipment. Swissmem, the Manufacturing Association, issued a stark warning that the 39% tariff would have an extremely severe impact. Stefan Bruckbacher, the association's director, expressed his profound astonishment. He asserted that these tariffs lacked any reasonable basis and were entirely arbitrary, adding that the decision placed tens of thousands of jobs within the industry at significant risk. Switzerland is globally renowned as the home of some of the world's most prestigious luxury brands and food products. With the tariffs scheduled to take effect on August 7th, the prices of iconic Swiss watches, chocolates, and cheeses are anticipated to surge dramatically. The 39% tariff drew strong disapproval from the Federation of the Swiss Watch Industry. They highlighted that, since 2024, Switzerland had abolished import duties on all industrial goods, thereby imposing no barriers on U.S. imports. The Federation articulated that these tariffs represented a serious problem for bilateral relations. Data from June indicated a prolonged decline in Swiss watch exports, particularly noticeable in the markets of the United States, Japan, and Hong Kong. Within the chocolate industry, multinational corporations such as Nestlé and Lindt & Sprüngli possess production facilities within the United States, enabling them to serve local customers directly. However, something else, Swiss small and medium-sized enterprises are projected to bear the brunt of the adverse effects. Roger Wehrli, Chief Executive Officer of the Association of Swiss Chocolate Manufacturers, Choco Suisse, stated that 7% of Switzerland's chocolate production is exported to the United States. He explained that not only would the 39% tariff pose a significant challenge, but when combined with the prevailing US dollar and Swiss franc exchange rates, the overall cost could increase by nearly 50%. He predicted that the industry would lose customers in the US market, leading to a sharp decline in sales. Speaking on a financial news program, Rahul Sahgal, Chief Executive Officer of the Swiss American Chamber of Commerce, described the tariff as deeply disappointing after numerous rounds of negotiations. Yet he expressed hope that this was not the final outcome. He pointed out that opportunities for resolution still existed, particularly in the days leading up to August 7th. Furthermore, he noted that the executive order itself left the door open, implying that if negotiations with the United States were ongoing, these additional tariffs might not be applied. In their agreements with the United States, some economies have committed to increasing investment in the world's largest economy. For instance, the European Union pledged a total of $600 billion alongside $250 billion for the purchase of U.S. energy. Regarding this solution, Mr. Sahgal indicated that Switzerland was considering a commitment of approximately $150 billion in investment, a figure remarkably substantial relative to the size of its economy. Switzerland already ranks as the 6th largest foreign investor in the United States, according to Mr. Sahgal. Pinpointing the exact sticking point in the negotiations or the precise methodology behind President Trump's 39% tariff calculation remains challenging. He highlighted Switzerland's difficult position. While it achieves overall trade balance when considering both goods and services with the United States, President Trump's focus was exclusively on the goods sector. He used an illustrative analogy. Switzerland is a nation of 9 million people, whereas the United States has approximately 300 million. Therefore, he explained, even if every Swiss person were to consume a bottle of bourbon, a piece of American beefsteak daily, and purchase a Harley-Davidson, Switzerland would still be unable to balance its goods trade with the United States. Beyond the official narrative, unanswered questions and speculations. While the official explanation for the 39% tariff centers on the U.S. trade deficit in goods, the unusual precision and punitive nature of this figure, especially when compared to the rates applied to other major economies like the EU and UK, invite deeper scrutiny and alternative interpretations. One line of speculation suggests that the tariff is not merely an economic measure, but a strategic power play. Could Switzerland's historical neutrality, its significant role in global finance, or its perceived independence from traditional blocs have made it the target for a more aggressive form of economic diplomacy. The U.S. administration might be sending a broader message to nations that maintain a degree of financial or political autonomy, signaling a new era where economic leverage is used to enforce alignment or extract specific concessions beyond conventional trade terms. Another perspective considers the timing and the specific industries targeted. Switzerland's dominance in high-value luxury goods, pharmaceuticals, and precision engineering gives it a unique economic profile. Is the tariff a direct attempt to force these industries to shift production or investment more substantially into the U.S.? Or perhaps to gain a competitive edge for American counterparts? The sheer magnitude of the tariff makes it a formidable barrier, potentially forcing Swiss companies to make difficult choices about their global supply chains and market access. Furthermore, the perceived failure of Swiss negotiators to secure a lower rate, despite their expectations, raises questions about the true nature of the discussions. Was there an unspoken demand or an unyielding position from the U.S. side that the Swiss were unwilling or unable to meet? Some observers might wonder if the 39% was a predetermined figure, a non-negotiable ultimatum disguised as a trade adjustment, designed to test the resolve of a smaller, yet economically powerful nation. The official narrative, while providing a clear numerical rationale, may not fully encompass the complex geopolitical and strategic undercurrents at play. The 39% tariff, therefore, could be seen not just as a response to a trade imbalance, but as a multi-layered signal in the evolving landscape of global economic power.